For those of you who watch my videos regularly, I call you back to a time not too long ago. This awkward period of time between Christmas and New Year's where we were talking about, okay, how do we take advantage of this time to handle our portfolio? What we were saying then was 2020 was a signature year, and that had caused signature moves in stocks that had benefited from the pandemic and working from home, staying at home, and working out at home had seen significant runs. And they were at very high levels at that period of time. And it had felt like, and is still kind of feeling like, those prices are maxing out, at least for the medium term. They have pulled forward a lot of optimism, and more importantly, they've pulled forward a lot of potential gains. And it's time to ring the register in those areas. We said to do that, and then to move the capital into the 2021 signature stocks, what I have been calling oil and energy, gold, and real estate, areas of the market that will benefit from inflation. I want to go back to the 2020 stocks. Things like Peloton, which are at incredibly high levels, great business, great product, but the valuation is just very high. And it's hard to make a case for that valuation to continue rising, especially as vaccines will become distributed. People will start returning to gyms. Equinox is a fantastic gym. No hate on Peloton, but it's a competitive industry. And one thing that you want to consider with regards to entrepreneurship, general markets, is competition is not a good thing, because then price wars kind of get involved. So fitness is a highly competitive space, and Peloton is a very expensive stock. And in order for the current valuation to be justified, it needs to continue eating market share and growing dramatically. And I'm not doubting it will grow to some extent, and it will eat some sort of the gym market share. But I'm not expecting any sort of explosive catalyst to continue to propel the stock forward. That's my personal opinion. And I think a lot of the gains that have been seen in the stock are going to be the gains that are there. And, if you have them, take them now and lock them in, because I don't know how much longer they're going to be there. Not saying, go short or anything. I'm just saying there's a lot more upward resistance on Peloton and similar stocks than there is on downward resistance. Now, let's take a focus on the 2021 stocks, which is the other half of that picture, which is kind of the forward-looking half of that picture that we had in that awkward week. We have seen energy rally pretty strong. The stock we called out in particular, ExxonMobil, has done very well. This is a name I've had for a very long time, not very long time, but since the beginning of December, not just, that 1 week. And has actually been acknowledged by a questionnaire, a poll of 100 top fund managers as the stock most likely to outperform in 2021. And we're beginning to see that. It's a good stock, pays a high dividend, and energy is going to begin to recover. A lot of the companies in the energy space, this is broader about the market, have been forced to become leaner businesses, cut production when they can, more particularly cut the production that costs the most to produce. So once energy prices return to higher levels, as they are beginning to and kind of are at right now, not historically, but relatively, and as energy demand begins to pick up, the margins on these businesses should begin to improve. And these are the cash flowing businesses out there. Energy, good cash flow from these companies. And you got to love your rights to good cash flow, right? Especially as an investor. So energy remains a good space. Now, gold obviously doesn't produce the same kind of cash flow that energy does. Warren Buffett in the past has been very critical of gold. He has said, gold doesn't produce anything, so I'm gonna stay away, at least not interesting to me. Well, it seems like he has somewhat reversed this stance given the interesting climates of 2020 by purchasing a large stake in Barrick Gold. And Barrick Gold does produce gold, so it's a company, it has a dividend. But Barrick Gold is especially interesting if there's price appreciation in gold. So if you are looking for price appreciation, gold is a good asset to have. I expect inflation to occur, as I'm sure many of you do. Joe Biden is going to be our next president, and that involves high levels of stimulus and relatively high levels of inflation. So gold, it's a very, very rare resource, and similarly, silver is pretty well underpriced. And the way these metals I have found are priced is based on the energy, like physical, actual energy, the labor it takes to produce that product. Which leads me to believe silver, in addition, is very underpriced, because if you actually study how these minerals are found in the ground and turned into these coins, it's very difficult. They're not in a big chunk, they're in very small pieces. So silver at 27 an ounce probably takes significantly over an hour to produce 1 ounce of silver. So with minimum wage being hiked to $15 an hour, you can kind of see how this equation begins to tilt in the favor of metals, just in terms of the amount of labor cost and all that it takes to produce these metals. So I would not shy away from the metals. I would not, exclusively invest in metals, but I'm not expecting you to do that, obviously. So get some exposure there. Now, real estate. I've talked to some people in real estate, and it seems like there's a right and a wrong way to go about real estate. We are expecting an inflation environment, at least me, at least the people who are taking me seriously. In an inflation environment, we don't want to be locked into contracts that are 10 or 20 years long, because year to year there should be some inflation, and our contracts should reflect that. Now, commercial real estate has obviously been hit. But let's say we ignore the fact that commercial real estate has been hit by the pandemic and everything recovers. Those leases are 10 to 20 years long, typically. Companies want to lock in their rent and get their people in and stay there. Yet, if there is significant inflation, you're not going to see that when you own commercial real estate for, some period of years. We don't want that. So with real estate, I would find REITs that either just have good physical assets and you're buying them as, a well-priced, like similarly to gold, well-priced compared to, the value of the asset, or something that has quickly adjusting cash flow, for example, hotels or multifamily real estate, where leases are typically no more than 1 year and at max 2, so they can kind of adjust quickly to the environment. So we're seeing energy do well and begin that 2021 trade. Gold, not so much. Interesting price action today, but no 2020 move yet, unlike energy. Similarly in real estate, doesn't seem like there's a 2021 move yet. There's still time in all three of these areas. The latter two have not had their moves and present even better buying opportunities. So I would get into these areas. And if you have 2020 stories that have seen massive gains, I would consider trimming them. That's the deal for today. And until next time, peace out.